Welcome to the deep dive. We've got a fascinating set of sources sitting here, all pointing towards two very specific, very visual patterns that traders have looked at for, well, a long time: the three white soldiers and the three black crows.
Yeah, these are true classics in the world of financial charting, signals that appear right there on the price itself. Real staples.
Exactly. Our mission today is to unpack these patterns for you. We're going to dig into where they actually came from, what they tell us about the constant, back and forth happening in the market.
The market psychology bit.
Right, that. And how you even spot them on a chart. Look honestly at how reliable they tend to be, and maybe most importantly, how you might think about using them or just understanding them when you see them pop up.
Think of this as getting a shortcut, maybe, to understanding some key visual cues that are really telling a story about the balance of power shifting between buyers and sellers.
All right, let's jump in right at the beginning. Where does this whole concept of Japanese candlestick charting, which these patterns are part of, even originate?
Well, uh, the story most people hear starts with a legendary Japanese rice trader, Munehisa Homa, way back in the 18th century. He was certainly a pioneer in analyzing market prices visually, looking at history to predict the future.
But the sources make a good point. The actual charts we see today, the ones with the specific body and wick structure, they seem to have evolved later, maybe closer to the late 1800s during the Meiji era.
Right.
So maybe Hama wasn't drawing charts that look exactly like the ones on your screen right now, but he certainly laid the groundwork for thinking visually about price action.
That distinction is important, yeah. And here's where it got brought to the Western world in a really significant way. The person who codified these tools and introduced them to traders outside of Japan was Steve Neeson,
Steve Neeson, right.
with his now standard book, Japanese Candlestick Charting Techniques, published back in 1991.
1991, that's surprisingly recent, for something that draws on centuries of history.
It is, isn't it? So patterns like three white soldiers and three black crows are part of this rich tradition that evolved over generations in Japan, and then Neeson systematized them, made them accessible globally. They don't have a single named inventor like some modern technical indicator might.
Got it. So, at their core, what are these individual candles visually representing, the building blocks?
Precisely. Each candle is telling you the story of the battle between buyers and sellers over a specific time period, whether that's a minute, an hour, a day, or a week. Where the price opened, where it closed, the high, the low, it's all there.
And patterns like TWS and TBC take that a step further, looking at the story over three periods to tell you something bigger, like a chapter instead of a sentence.
Exactly. They are tools tested by time, visual representations of common market psychology, but they absolutely need to be applied with modern market dynamics and, the broader context in mind. Can't just use them in a vacuum.
Okay, let's talk about their main job then. What are these two specific patterns primarily known for signaling? What's their purpose?
They are primarily known as reversal patterns. That's their key function. They suggest that the existing trend might be running out of steam and could be about to change direction, a potential turning point.
Okay, so let's break that down. The three white soldiers, TWS, what's that one telling us?
This is your classic bullish reversal signal. So if you see this after a period of falling prices, a downtrend, it suggests a potential shift from that downtrend to an uptrend. It's like the buyers have finally mustered their forces and are starting to take control after a period where sellers were clearly dominant.
Makes sense. And its counterpart, the three black crows, TBC, the opposite story.
Exactly the opposite. That's the bearish reversal signal. You'd look for this after an uptrend, after prices have been rising. It suggests a potential shift from rising prices to falling prices. This is the visual of sellers gaining dominance after a rally has potentially exhausted itself.
So for you looking at a chart, how does spotting one of these translate into action or just understanding what might happen next?
Well, traders look at these as potential signals for either entry points you might consider buying after a confirmed TWS, anticipating the new uptrend, or maybe selling or shorting after a confirmed TBC, anticipating the new downtrend.
Or maybe getting out of a trade.
Or they use them as exit points, absolutely. Perhaps getting out of a short position if a TWS forms, suggesting your reason for shorting is weakening. Or exiting a long position if a TBC appears, suggesting the rally might be over.
And the sources point out these patterns aren't confined to just one market, right? You can look for them pretty much anywhere.
Yeah, you can look for them in Forex, stocks, commodities, even crypto these days. And across different time frames, short intraday charts, like the 5-minute or longer weekly or even monthly charts,
But there's a caveat there, isn't there, about time frames?
Yes, the sources do suggest that the reliability tends to be higher on those longer time frames. Think about it. A shift in power that lasts for 3 whole days or 3 weeks might be more significant and sustainable than one that just lasts for 3 minutes on an intraday chart.
That makes intuitive sense. Now, here's an interesting point from the source, though. While they signal a reversal of the previous trend,
Uh-huh.
the patterns themselves, 3 consecutive moves in one direction, are also confirming that a new short-term trend is actually starting. It's doing two jobs at once.
That's the nuance, exactly. The pattern signals the end of the old trend and the beginning of the new one.
Yeah.
But the potential downside is that by waiting for 3 full candles to form, you're entering the trade after the first push of that new move has already happened.
Which means you might be giving up some of the potential profit
Right.
and potentially impacting your risk-reward ratio because your entry isn't right at the bottom or top.
Exactly. You're maybe trading a higher probability signal because you waited for confirmation, but potentially from a less ideal entry price compared to someone who got in earlier based on, say, just the first candle of the pattern or some other signal. Trade-offs, always trade-offs.
This is where it gets really interesting, I think, because these patterns aren't just mechanical shapes. They are deeply rooted in market psychology. They're telling a human story.
That's their enduring power, absolutely. They visually tell the story of emotion and conviction playing out between buyers and sellers, candle by candle. You can almost feel the shift.
Let's actually walk through that story for each pattern as we talk about how to spot them. Let's start with the 3 white soldiers appearing after a downtrend. Candle 1.
Okay. So prices have been falling. Sellers are clearly in control. Maybe there's fear or pessimism. Then the first candle of the potential pattern appears. A strong bullish candle, usually white or green. What's the psychology there?
Buyers fighting back.
Exactly. Buyers are finally fighting back. Maybe sellers are taking profits after the nice decline, or value buyers are stepping in thinking prices are cheap now. It's the first real sign of buyer strength emerging from the gloom.
Then comes candle 2. You're looking for another bullish candle. And the rule is it ideally opens within the body of that first candle and closes even higher. What does that specific opening tell you? Why inside the previous body?
That's key. The fact that it opens within the prior candle's real body rather than gapping way down suggests the sellers couldn't even maintain their push at the start of the new period. Buyers stepped in pretty quickly off the open,
Okay.
and the fact that it closes higher than the first candle, that shows the buyers aren't just holding their ground. They're actively gaining strength, attracting more conviction, maybe making those remaining sellers nervous and starting to cover their shorts.
And candle 3 seals the deal. A third bullish candle, ideally opening within the second's body and closing even higher again. The final soldier.
This is the visual confirmation of the power shift. Buyers are now clearly in control. The upward momentum is building, becoming obvious. Optimism and confidence are spreading as prices continue to rise decisively over 3 straight periods. The sellers are in retreat.
And when the sources talk about the ideal characteristics for these candles, they emphasize long bodies. Why is that so important?
Long bodies show decisiveness, conviction. A long green or white body means buyers were firmly in control from near the open to near the close of that period. They pushed price up and held it there. A long red or black body means sellers dominated. Short bodies, conversely, show indecision, like a hesitant battle with no clear winner for that period.
And ideally short or no wicks. What do the wicks or shadows tell us?
Wicks or shadows show where price traded briefly during the period, but was ultimately pushed back by the opposing side before the close. So short wicks mean that the dominant side buyers, in the case of white soldiers, maintained control throughout most of the period and didn't let the opposing side push the price back significantly. It adds to the picture of strong, unwavering control. Long wicks show struggle.
Got it. Now, the 3 black crows pattern tells the mirror opposite story, usually appearing after an uptrend, right?
Right. Prices have been rising, buyers are confident, maybe things are getting a bit frothy. Then the first candle of the pattern appears. A strong bearish candle, red or black. This is the first serious sign of weakness. Sellers are starting to take control, perhaps early buyers cashing out at the highs, or maybe some negative news hits the wires.
Candle 2. Another bearish candle, ideally opening within the first candle's body
Same logic as before.
and closing lower.
That opening again shows the weakening resolve of the previously dominant side in this case. The buyers couldn't even push the price up much at the start of the period. Sellers took control quickly. The lower close shows selling pressure is building, maybe causing concern or even panic among those still holding long positions from lower levels.
And candle 3, a third bearish candle, opening within the second and closing lower still, the third crow.
This solidifies the pattern. Sellers are now completely dominant. Fear about a potential downtrend is spreading. The conviction is clearly shifted to the downside. The buyers who were recently confident are now questioning their position.
And just like the soldiers, ideal crows have long bearish bodies, showing decisive selling, and short or no wicks, meaning sellers maintain control throughout.
That's right. The power of these patterns comes from seeing this clear, visual story of the balance of power flipping dramatically over 3 consecutive periods. It's a snapshot of market psychology in action, playing out right on the chart.
And the source wisely highlights that the market context before the pattern matters just as much, maybe even more than the pattern itself.
Oh, absolutely. Context is crucial. A signal is much stronger if it appears after a long, clear, and arguably exhausted trend.
What exhausted?
Well, if the market has just been churning sideways in a range, a 3-candle move might just be noise within that range. But if it's been grinding relentlessly down for weeks, getting very oversold perhaps, and then you see 3 strong white soldier candles emerge, that shift in power is much more meaningful because the previous downtrend had likely run its course, run out of steam. The reversal has more potential energy behind it.
So let's get practical then. How do you actually spot these on a chart? There's a sort of checklist you run through, isn't there?
Yeah, a mental checklist or even an automated one. First step is always context. Was there a clear preceding trend? Downtrend before looking for TWS. Uptrend before looking for TVC. As we said, the source stresses they're less reliable in sideways or choppy markets because there's nothing distinct to reverse from.
Right, makes sense. Then you examine the 3 candles themselves in sequence.
For 3 white soldiers, you're looking for 3 consecutive bullish candles, usually green or white, depending on your chart settings. Each one needs to open within the real body of the prior candle.
And close higher than the prior candle's close. Each close is progressively higher.
And they should have those important long bodies and ideally short or no wicks. Those characteristics tell you the strength and conviction behind the move. Real power.
And for 3 black crows, same idea, but inverted. 3 consecutive bearish candles, red or black. Each one needs to open within the body of the prior candle.
And close lower than the prior candle's close. Progressively lower closes.
And again, looking for those long bodies and ideally short or no wicks to show seller dominance.
The source mentions you can follow a flowchart logic for this, which is helpful. And it's true, you could even automate detecting these patterns using code like PineScript on TradingView or libraries in Python like TALib. That helps with consistent identification, takes out the guesswork.
It does. But here's a crucial reality check the source mentions, and I think it's really important. Finding perfect textbook patterns with super long bodies, 0 wicks, and absolutely perfect opening overlaps, that's pretty rare in the messy real market, isn't it?
Absolutely. You're going to see imperfect variations all the time. Maybe one candle has a slightly longer wick, maybe the bodies aren't perfectly long, maybe the open is just slightly outside the prior body.
So what do you do then?
This is why judgment is needed. It's not just a rigid mechanical rule-checking exercise. You have to weigh the evidence, look at the overall picture, understand the psychology, even if the shape isn't textbook perfect. Does it still tell that story of a power shift?
Spotting the shape, even an imperfect one, is step 1. But these patterns aren't standalone magic bullets. They come with assumptions, and the reliability is significantly boosted by confirmation, as you've mentioned.
Exactly. We need to reiterate the need for that clear preceding trend. If you see 3 white soldiers appear smack in the middle of an already strong uptrend, it's probably just a continuation signal, not a reversal signal. Context matters.
And emphasize again the importance of those sufficiently large candle bodies and short wicks. If the bodies are small, like spinning tops, or the wicks are long relative to the body, that's a red flag.
It's a sign of indecision or significant pushback from the opposing side. That weakens the signal dramatically. For instance, a long upper wick on the 3rd white soldier candle means sellers showed up strongly before the close and pushed price back down hard. That's hardly a sign of unchallenged buyer dominance, right? It muddies the picture.
Okay, this is where another critical layer comes in, something the sources really emphasize: volume confirmation.
Yes, volume is crucial.
Okay, tell us about volume. Why is it so important here? What's it adding to the story?
For 3 white soldiers, ideally, you really want to see volume increase over those 3 bullish candles, especially picking up steam on the 3rd candle. Why? Volume represents participation, the amount of shares or contracts traded.
Oh,
Increasing volume confirms that more and more market participants are buying into this potential reversal and the new upward move. It lends strength and conviction to the pattern. It's like more people voting for the uptrend.
So a TWS on low, or worse, decreasing volume, that's suspicious.
It's a major warning sign. It suggests the move might lack broad support. It could just be a weak bounce driven by a few players, and it might fizzle out quickly. Low volume is low conviction.
Got it. So it's like getting more and more people agreeing with the new direction.
That's a great way to put it. And for 3 black crows, it's the same logic, just inverted. Increasing volume confirms strong selling pressure and broad market agreement on the downside. It means a lot of participants are actively pushing prices lower with conviction. High volume selling is scary for the bulls.
This is a key takeaway, repeated multiple times in the sources, and it's worth hammering home. No pattern is 100% reliable on its own. TWS and TBC should not be used as standalone signals. Don't just trade the shape.
Absolutely correct. They need to be confirmed by other technical analysis tools and indicators like the volume we just discussed, or support resistance or oscillators. Ignoring these conditions, just trading the raw pattern, is a common recipe for getting caught in false signals or whipsaws and taking unnecessary losses.
Okay, the million-dollar question then. How reliable are they? Do they actually work consistently? What do the numbers say?
The numbers. This is where the picture gets interesting and requires some critical thinking. Reliability is measured by various metrics, like how often price moves in the expected direction after the pattern forms. That's the win rate or accuracy.
Right.
The overall profitability of trades, based on the signal profit factor, the potential biggest losing streak or dip in equity, maximum drawdown, the risk-reward ratio achieved, and even just how often the pattern appears, frequency.
And the sources present, well, kind of varying results, don't they?
They do. Some sources, like Luxalgo mentioned in the material, report quite high historical reversal rates based on their specific backtesting, like 78% for TBC, and even 80–90% for TWS under certain filtered conditions.
Those sound pretty good, 80–90%.
Those are certainly attention-grabbing numbers, suggesting they can be powerful signals when filtered correctly. However, it's crucial to see those numbers in context. Other broader studies, like a 40-year one mentioned regarding candlestick patterns in general, suggest that the average success rate of many traditional patterns has actually decreased over time, although maybe there's been a slight recovery recently.
So high numbers in specific tests from one source, but a hint that perhaps overall pattern reliability might have waned over the decades. What do you think that variation tells us? Why the difference?
It tells us a few really important things, I think. First, those high numbers likely depend heavily on how the test was done, which specific market was tested. Stocks, .forex, .crypto, which time frame, what precise, maybe strict criteria were used to define the pattern, remembering those imperfect variations we talked about.
Right, how perfect did it have to be?
And most importantly, what filters were applied. Were they only looking at patterns that were also confirmed by increasing volume? And that bounced off a key support level, and where RSI was oversold. Or were they testing the naked pattern in isolation? The conditions of the test are absolutely everything.
So the high success rates might come from combining the pattern with other confirming factors, not just the pattern itself.
Precisely. That's usually how profitable strategies are built to confluence. And second, markets evolve. With the rise of algorithmic trading, high-frequency trading, AI, and just different market structures and participants over the decades, traditional visual patterns that worked maybe more consistently 50 years ago might be interpreted differently today, or simply traded against by sophisticated systems looking for stops above or below them.
That's fascinating. So it's not just about the pattern, but how the market structure and the players within that structure interact with it, and that interaction changes over time.
Exactly. Which is why historical results, while informative and useful for understanding probabilities, are never a guarantee of future performance. The market is a dynamic, adaptive system. What worked last year might not work next year.
So this really highlights the importance of not just blindly accepting a statistic you see online, but understanding its context, how it was generated, and potentially doing your own backtesting and validation on the specific assets and timeframes you trade.
Absolutely. Due diligence and ongoing testing are key. Don't just take someone's word for it.
Okay, how do 3 white soldiers and 3 black crows compare to other common reversal patterns people might be looking at? How do they stack up?
Good question. Let's look at a couple mentioned in the sources. First, engulfing patterns, the bullish engulfing and the bearish engulfing.
Yeah, I've definitely heard of those. Very common.
Right. Similarity. They are also considered strong reversal signals. Bullish engulfing suggests an upside reversal, much like TWS. Bearish engulfing suggests a downside reversal, like TBC. Same job, basically.
Okay, what's the key difference in terms of the visual structure?
The main difference is the number of candles. Engulfing is a two-candle pattern. The second candle's real body completely engulfs or swallows the real body of the first candle. TWS and TVC, as we know, are three-candle patterns.
So engulfing is a quicker signal. It happens faster on the chart?
Yes, potentially. It can signal a reversal in just 2 periods versus 3. The source suggests that because TWS and TVC unfold over 3 candles, they might offer more internal confirmation of the shift in power you see that sustained push. Engulfing relies more heavily on a single, very decisive move on the second candle to show the power shift. It's a slightly different visual story, a quicker, sharper turn, perhaps.
Got it. 2 candles versus 3. How about morning star and evening star patterns? Those sound more poetic.
They do, again, similarity. There are also 3-candle reversal patterns. Morning star is bullish, like TWS. Evening star is bearish, like TVC.
Okay, same number of candles as TWS, TVC. 3 periods. So what's different in their structure? How do they look?
The key difference is the middle candle, the second candle of the 3. In morning star and evening star patterns, that second candle is typically very small, often a doji, where open and close are virtually the same, or a spinning top, which have tiny real bodies.
And a small body tells us, we touched on this.
Extreme indecision. It shows the market pausing, hitting a point of equilibrium or stalemate after the initial trend exhaustion, represented by the first candle. Neither buyers nor sellers could gain significant ground in that crucial middle period. Then the third candle shows the new side taking decisive control, confirming the reversal after the pause.
Ah, I see the psychological difference now. TWS and TBC show a more continuous, decisive push by the new dominant side over all 3 periods. Push, push, push. Star patterns show push, then pause, hesitation, indecision, the small middle candle, then the decisive reversal push on the third candle.
Exactly. So TWS, TBC represent a more direct and continuous transfer of power, while star patterns show a moment of significant doubt before the turn. Both are 3-candle reversals, but they tell slightly different stories about how that reversal unfolded.
And just to quickly tie this back, while these are all visual price patterns, technical indicators like RSI and MACD are absolutely crucial companions for confirmation. They don't replace the pattern, but they add layers of evidence to support or refute its signal, right?
Precisely. They help you understand the momentum, the strength, the overbought, oversold conditions behind the visual pattern. They give you more context.
Okay, so given that these patterns aren't reliable enough on their own, how can you really make them work better? How do you use them effectively in the real world, practically speaking?
This is where you combine them with other analysis tools, as the source strongly recommends. It's all about building a case, looking for confluence, multiple signals pointing in the same direction. Don't rely on just one piece of evidence.
We already stressed volume confirmation, but it's worth repeating because the sources keep bringing it up. It seems foundational.
It's that important, yeah. Always look for increasing volume, confirming the direction implied by the pattern. It shows conviction, participation. It validates the move.
And using other technical indicators for confirmation, you mentioned RSI and MACD.
Crucial. Let's recap. For RSI, which measures the speed and change of price movements, momentum, basically. For a TWS, you ideally want to see RSI moving out of oversold territory, meaning below 30, or perhaps showing bullish divergence.
What's bullish divergence again?
That's when price makes a new low, but RSI fails to make a new low. It makes a higher low instead. It suggests downside momentum is waning, even as price dips lower, often preceding a turn.
Okay, so RSI is supporting the reversal idea.
Right, and for TBC, you look for the opposite. RSI moving out of overbought territory, above 70, or showing bearish divergence. Price makes a new high, RSI makes a lower high. The source explicitly warns, avoid trading a TWS signal if RSI is already deeply overbought, or a TBC signal if RSI is already deeply oversold.
Why? Because the move is already stretched.
Exactly. It's like trying to signal a reversal right when the momentum in that direction is already hitting an extreme limit. The odds are less favorable for continuation. You want the indicator to support the start of a new move, not confirm the end of the one you're trying to fade.
Makes perfect sense. What about MACD?
MACD shows the relationship between 2 moving averages and helps identify momentum shifts. Look for a bullish crossover, the faster MACD line crossing above the slower signal line, happening around the time the TWS pattern forms, confirming the shift to upside momentum. For TBC, look for a bearish crossover, MACD line crossing below the signal line, confirming downside momentum.
And moving averages themselves, just simple MAs on the chart.
Yes, they act as dynamic support and resistance. A TWS signal is much stronger if the pattern completes with the price breaking and closing above a key moving average, like the 20-day, 50-day, or the widely watched 200-day MA. It shows not just the three-candle pattern, but also a breach of a significant potential resistance level.
Adds another layer of confirmation.
Exactly. And a TVC is stronger if the price breaks and closes below a key MA, confirming a break of potential support.
What about Bollinger Bands? How do they fit in?
Bollinger Bands measure volatility and define relative highs and lows. A TWS appearing near the lower Bollinger Band or a TBC appearing near the upper Bollinger Band can add confidence. It suggests price had moved potentially excessively far from its average, the middle band, and might be due for a reversion or snap back towards the mean, which aligns nicely with the reversal patterns message.
Okay, and multi-time frame analysis is also key for getting the bigger picture right, not just looking at one chart.
Absolutely crucial. Cannot stress this enough. If you see a promising TWS on, say, a 1-hour chart, zoom out. Look at the 4-hour or the daily chart. What's the bigger trend doing? Is the overall context supporting a potential upside move? Or are you seeing this bullish pattern forming right underneath major long-term resistance on the daily chart? That would be a warning sign.
So check the higher time frames for roadblocks or confirmation.
Yes. Look for major support and resistance levels on those longer-term charts. A pattern is much more likely to succeed if it aligns with the path of least resistance on multiple time frames.
And speaking of support and resistance, this seems like maybe the most important context factor.
It's huge, yeah. Arguably one of the most critical. A TWS pattern is significantly more reliable, statistically and logically, if it forms right at or just above a strong, established horizontal support level or a rising trend line. That support acts like a floor, confirming that buyers have a defensive line they're holding, adding significant weight to the TWS signal, suggesting they're taking control from that key level.
And for TBC?
The opposite. A TBC is much more reliable if it forms right at or just below a strong horizontal resistance level or a falling trend line. That resistance acts as a ceiling, confirming sellers are active in defending that level, reinforcing the TBC signal that price is likely to turn down from there.
So it's not just seeing the shape anywhere on the chart, but where that shape appears on the map of key price levels. Location, location, location.
Exactly. Context, context, context. Pattern plus location plus volume plus indicator confirmation, a much higher probability setup.
Okay, and even if you have all that confluence, all those signals lining up, you can't ignore risk, can you?
Absolutely not. Never. Strict risk management is non-negotiable for any trading approach, whether pattern-based or something else. The market can always do the unexpected.
So first rule, always use a stop loss.
Yes, this is your escape hatch, your protection if the signal fails and price goes against you. For a TWS trade going long, a logical stop loss placement is typically below the lowest point of the entire three-candle pattern, maybe the low of the first soldier candle, or just below the nearby support level that the pattern bounced off.
Gives the trade some room to breathe, but cuts losses if it breaks down.
Right. For a TBC trade, going short, place a stop loss above the highest point of the pattern, perhaps the high of the first crow candle, or just above the nearby resistance level it formed below. This limits your potential loss if the market unexpectedly rallies instead of reversing down.
And just as important as knowing where to get out if you're wrong is knowing where to get out if you're right. Define a take-profit target.
Yes, have a plan for taking profits.
Yeah.
Don't just ride it forever hoping. Use logical price targets. Look left on the chart for previous significant support or resistance levels that price might reach. You could use Fibonacci extensions based on the pattern or the prior trend, or simply aim for a predefined risk-reward ratio,
Like what?
like trying to make 2 or 3 units of profit for every 1 unit you risked with your stop loss. So aiming for a 1.2 or 1.3 risk-reward ratio. This ensures your winners are significantly bigger than your losers over time, which is key to long-term profitability.
The sources also mentioned you can tune the exact criteria for the pattern itself, like what constitutes a long body or short wick, based on backtesting results and experience with specific markets or assets. It's not one size fits all.
Right. Markets have different volatility characteristics. What looks like a really long body on a highly volatile crypto chart might be considered pretty average or even short on a slow-moving, stable blue-chip stock chart. Tuning helps you adapt the pattern definition to the specific personality or volatility regime of the instrument you're trading. Backtesting can help you find what criteria worked best historically for that specific asset.
And Automating the detection, as we mentioned earlier, using code, helps enforce those specific tuned criteria consistently and is really valuable for that kind of testing, right?
Definitely. Automation takes the subjective squint test out of identifying the pattern based on your specific rules. This frees up your mental energy to focus on the more crucial part. Interpreting the pattern's significance within the broader market context, considering all those confirmation factors we discussed, that's where the real skill and judgment lie.
So, looking ahead, what's next for how we understand or use these visual signals? The sources hint at some pretty exciting future directions, maybe involving more tech.
Yes, it seems so. The source points to areas like using machine learning and deep learning, specifically things like convolutional neural networks, CNNs, which are very good at image recognition. The idea is they could potentially identify these candlestick patterns and maybe even subtler variations or combinations that humans tend to miss, perhaps with higher accuracy.
So, AI learning to see the charts in a sophisticated way, that's kind of cool.
In a way, yes. Teaching algorithms to recognize these visual patterns? Early studies apparently show some promise, but integrating simple pattern recognition into more complex, consistently profitable ML trading strategies is still an active and challenging area of research. It's not as simple as just spotting the pattern.
More rigorous quantitative analysis is also needed, the sources suggest, moving beyond just visual inspection.
Absolutely. To move beyond anecdotal evidence or simple backtests towards truly understanding their probabilistic performance across many different markets, time frames, and varying volatility conditions. Developing sophisticated statistical models that can estimate the likelihood of a signal working based on a confluence of factors. The
Yeah.
pattern's exact shape, the volume signature, the indicator readings, the location relative to SR that would be very powerful for traders.
Combining patterns with news and market sentiment analysis seems like a logical next step, too, trying to understand the why behind the pattern.
It is. Understanding if a potential reversal signal, like TWS or TBC, is aligning with a genuine shift in underlying fundamentals or market sentiment, or if it's just technical noise or a short-term fluctuation, could be a significant filter for weeding out false signals, adding that qualitative layer.
And optimizing those entry and exit rules using algorithm, finding the statistically best points.
Definitely. Using historical data and optimization techniques to find the statistically best places to enter after a pattern is confirmed, maybe not immediately, maybe on a pullback, and the optimal ways to manage the trade and exit for profit or loss based on probabilities.
It really sounds like the future of using these age-old patterns might be a fascinating blend. You've got that irreplaceable human ability to visually interpret the story the chart is telling, the psychology, combined with the raw power of modern data analysis tools to validate, confirm, quantify, and refine our approach.
Exactly. A more informed, robust, evidence-based way to apply these time-tested visual cues. The best of both worlds, perhaps.
So after digging into all these sources, what stands out most to you about the 3 white soldiers and 3 black crows? Your main takeaway?
For me, it's really how they function as these powerful visual narratives hacked into just 3 bars. They're time-tested ways the market visually shows you a potential, sometimes dramatic, flip in conviction. The story of bearish fear giving way to bullish confidence with the soldiers, or bullish greed breaking down into bearish fear with the crows. It's market psychology made visible.
They offer concrete potential signals for reversals, visual cues that really jump off the chart once you know what to look for.
They do.
Yeah.
But the absolute key takeaway, the thing that was hammered home again and again by all the sources, is that while they are visually quite easy to spot, their real predictive strength lies not just in the pattern shape itself, but overwhelmingly in its context and confirmation.
Right. You absolutely have to see the preceding trend. You need to check the volume for validation. You should look at what the indicators like RSI or MACD are doing. And critically, where on the chart the pattern is forming in relation to those key support and resistance levels.
And even if you stack up all those confirmations, making a strong case, you still must use strict risk management, your stop loss and your take profit plan, because no signal, no matter how good it looks, is ever going to be perfect.
Yeah.
The market will always find ways to surprise you.
As the sources hint, the success in using these patterns often goes beyond just mechanically applying a checklist. It seems to require developing experience and judgment over time to interpret those inevitable, imperfect patterns you'll constantly see, and to truly understand the broader market picture they sit within. That's the ongoing challenge, isn't it? And maybe the most rewarding part.
Definitely something to keep exploring on your own charts, applying these ideas and seeing how they play out. It takes practice.
Absolutely. Well, thanks for sharing these sources and digging into this with us for this deep dive.
My pleasure. Always fascinating stuff.